Warren Buffett has said diversification is protection against ignorance. And he's right, but his actions show that he accepts his ignorance. You can learn a lot by listening to great minds of our time, but you'll learn more by watching what they actually do. In Buffett's case, he has a widely diversified portfolio. His holding company, Berkshire Hathaway, owns stock in airlines, banking companies, oil businesses, and technology firms. And it doesn't stop there. Berkshire owns Geico, See's Candy, BNSF Railway, Fruit of the Loom, and many other companies. So don't draw the wrong conclusion when you hear Buffett's quote. Warren Buffett accepts his ignorance. Now, before we really get into it, I'd really appreciate it if you just tap the like button down below as well as subscribe to my channel. It means a great deal to me. Ignorance is a lack of knowledge or information, and since we're not all knowing, we're all ignorant to some degree. Even when someone takes decades to learn a topic, there's still gaps in knowledge. When it comes to a large business, there are thousands of moving parts. Even if you research a business for decades or help manage the company, you can still miss vital information. For example, Enron auditors and even the board of directors miss seeing billions of dollars in losses. Jeffrey Skilling and other executives use shady accounting tricks to hide failed deals and manipulate some other prices. Enron had just over $100 billion in sales in the year 2000. But the next year, it filed for bankruptcy. So no matter how well you think you know a business, there's always risk. You might overlook important information or someone might withhold it. This is one powerful reason you shouldn't put all your eggs in one basket. When it comes to risk, I remind myself with a greater loss, it takes a bigger gain just required to get back to break even. For example, a 10% loss takes an 11% gain to get to break even. A 20% loss takes 25%. Now, if I lost 50%, it would take 100% just to get back to break even. The bigger the loss, the larger the gain required to get back to where you started. And the biggest example, if you lost 90%, it would take a 900% gain to reach break even. And a 900% gain doesn't come around too often. With this in mind, let's look at how diversification helps lower the risk of big losses. How is diversification a hedge against ignorance? If you own a basket of investments and one tanks, the other assets can help it stay afloat. This is true as long as the investments aren't perfectly correlated, and the less correlated, the larger the diversification benefit. Let's say you own a small property worth $50,000, and on top of that, you invested another $50,000 in your favorite company, let's say shares of Apple. So a total $100,000, half in a small property, half in Apple stock. But over the coming year, a fire demolishes the property, and since you forgot to insure it, it's a complete loss. But on the upside, let's say the company shares, Apple shares are up 10%. So overall, your starting $100,000 is down to $55,000. That's much better than a 100% loss if you stuck it in all into, let's say, upgrading that property. Now, this is a simple 2-asset portfolio, but as you add more assets, you can further limit losses. Also, it's great to diversify, but if you own hundreds of assets, it can be a hassle to manage. Fees, taxes, and other expenses can really add up. So more isn't always better. On top of that, the benefits of diversification drop as you add each new position. There's some fancy math to back this up, and I could go into great detail. That's thanks to my finance background and passing the CFA exams, but I'll save you that time. Instead, I've created a chart for you that sums up the benefits, or the dwindling benefits of diversification. With each new holding added, the standard deviation drops less, and standard deviation is a measure of risk. It's approaching a limit that helps mark where systematic and unsystematic risk meet. Now, a great question. How many assets is too many? A good rule of thumb is no more than 20 positions. And some of the world's best investors concentrate their positions in 10 or fewer at one time. Now let's get back to Warren Buffett's quote. There's a big takeaway. So Warren Buffett uses diversification to protect against ignorance. All of the world's top investors do the same. Although Buffett isn't as diversified as his portfolio appears. Modern portfolio theory suggests adding higher portion of bonds, alternative investments, and other assets. Now, this can increase your total risk-adjusted return in the short term, but long-term investors, like Buffett, know stocks have better risk-adjusted returns in the long run. That's 10 plus years. As a result, the majority of Buffett's wealth is tied up in the stock market. And on top of that, Berkshire Hathaway's top 10 positions make up more than 80% of his total portfolio. This strategy has clearly worked and has helped Buffett become one of the world's best investors. Now, since I also have a long-term investment horizon, I'll follow Buffett's lead. After the next market correction, I plan on boosting my stock asset allocation close to 100% of my total portfolio. And I'll keep my portfolio manageable with about 10 to 20 companies. In summary, I'll continue to seek out and read insight from great investors, but always with a grain of salt. Ultimately, actions speak louder than words. So follow the money if you want real answers. Money is simply a measuring stick of value. I really appreciate that you watched the video I put together. I hope it helped you think about diversification a little bit differently. And I'd really appreciate it if you just tap that like button down below, as well as subscribe to my channel. Also, feel free to leave any comments, and you can check out my other recent videos.